I'm Michael Smith.
I'm Chuck Osborne,
and welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
It's Wednesday, June 21st, 2023. This is the third episode of the Iron Capital Podcast. So let's get to it, Chuck. What's on your mind?
Equity, Michael. Equity is on my mind, and particularly that there is no equity in the equity market.
Well, that's a bit of a different take than we were used to hearing about the word equity. But
well, we got a little wordplay there, but you've got a situation in the markets where, as of June 1, you got 7 stocks that are up combined, kind of average about 60% or so in the S&P 500, and you got 493 stocks that have an average return of zip, nada. And so that is not a very equal distribution of returns.
No, that's the opposite of that, isn't it?
That is the absolute opposite. We have some, I think we got some artificial intelligence privilege going on.
Well, let's dive into that. But first, let's set it up a little bit, and let's talk about a little bit about what happened last year, because that kind of primes the pump of explaining what happened this year a bit.
Well, right. So last year in the stock market, you had a year where value really outperformed growth. And when we talk about value versus growth, these are philosophies of investors where a growth investor is looking for companies that are on the cutting edge, that are going to grow very rapidly. Usually you're talking about technology companies, could be healthcare, biotech, something like that, where these are companies that have innovation that are going to make them grow faster than the economy as a whole. And those types of investments have been in favor for a long time, really since the financial crisis.
Yeah, since the financial crisis.
In 2008. And the other type of investor that people think about, and Warren Buffett is the kind of the poster child for this, is that you think about an investor who is looking for bargains. He's looking for a stock that's gone on sale. So for some reason, the price of the stock is not really reflecting the true value of the company. Value investors tend to find bargains in more traditional industries, industrials, energy companies, things like that. And they really did very well, relatively speaking, in 22. And especially at the end, when we did get the rally, that is what led the way from a pretty dramatic standpoint.
Yeah, that's right. To put that in context a bit, so large cap growth, the big growth companies that are household names, down roughly 30% in 2022, whereas the large cap value companies, the household names, banks, insurance companies, down 7.5%. That's an enormous performance divergence.
Yeah, that is a big difference, and that also is why dividend-paying stocks, for example, last year, which tend to be more attracted to value-type investors, they did very well.
Yeah, dividend-paying stocks did even better. So dividend stocks tend to be in the value cohort, but within value, dividend-paying stocks did even better than value as a whole for the year.
Right, absolutely.
Yeah, and that was a huge divergence too.
Right. But one of the most powerful forces in investments is what we refer to as a reversion to the mean, which is a fancy way of saying everyone has a way of eventually going back to the average. So whatever the average is, most stocks usually end up getting there eventually. And so we started in 2023 with those growth companies that had been so beaten up really coming back and outperforming the value companies in the first quarter of 2023, which would really, to us, just look like a normal reversion. You've got nothing happens in a straight line. You go back and forth, and that was a situation where the growth stocks have been way behind in 2022, and they kind of caught up at the beginning of this year. But somewhere along the line, it kind of shifted, and it all became about artificial intelligence.
Yeah. AI became the theme du jour for the market. What
Right.
everyone was talking about. Which I'm sure everyone listening to this has had to have everyone in the world talking about Chat GPT and whatnot. Right. This is a big topic of conversation with.
It is a big topic of conversation, and rightfully so. It's an exciting new. It's not even really that new.
It's not that new.
It's been around for a long time. We had a fairly significant breakthrough in the last year or so with Chat GPT,
Which is really just the most visible sign of that technology that's kind of being used in the background in a lot of other places. You had what a lot of, if you talk to the people that are actually deep in that technology, you had a step function
right,
in that technology, of which Chat GPT was a way for normal people to see it and interact with it in a way that you normally can't.
right, absolutely, and that has really led to a lot of excitement in that area, and it is the stocks that are most closely associated with that technology that have been the ones that have really taken off and led the market. And a lot of this divergence, you'll hear people talking about it being a year-to-date phenomenon, and those numbers I quoted were year-to-date. But so much of it happened in the month of May. I mean, it really was kind of a crazy month where you had a very select number of stocks just going through the roof, while everything else, quite frankly, was not just staying flat, it was getting beaten up.
Yeah, it was actually down. Over that month,
Right.
a lot of other stocks were actually down.
Yeah,
the majority
absolutely.
of the other stocks
I think
were actually down.
there are going to be a lot of stock investors are going to go, when they get their statements, like, what the heck? I mean, I actually have a negative return here, and everything on the news says the markets are up. Well, 7 stocks are up.
Yeah, that's right. There are 7 stocks
So,
that are
right.
up, and the biggest one of those, which all of them tie into the AI craze, right?
Correct.
But NVIDIA is kind of the poster child, so it probably makes sense to talk a little bit about NVIDIA and what it does and why it is seeing the resurgence after, by the way, falling something like 70% in 2022. Let's not forget that.
Right,
That
NVIDIA
occurred.
has definitely it's a roller coaster stock, and it's been all over the place throughout its history. But NVIDIA is known as, it's a chip company. It has a technology that makes most of the chips that are more advanced than your everyday chip, that are empowering a lot of this artificial intelligence technology. And so that's what they do, and that's why people are excited about them. And they are up 192% year to date.
Yeah, so they've flown. Yeah, that's right. So this AI stuff takes an enormous amount of processing power, a shocking amount. So NVIDIA was started in the late 90s. They make what are called GPUs, which are graphics processing units, versus CPUs, which is what we've always thought with normal chips. And they came about because in the late 90s, these video game systems took so much graphics power that they had to come up with a new type of a chip to power those graphics. And fast forward to now, and you've had a couple of different instances where there are some technologies that just need this unbelievable power of processing. One was the mining of Bitcoin, which is ridiculous, and we can talk about another day.
Right.
You just sit, you have to iterate as much as possible. But the second big push here is, again, it's with AI. It's these iterative technologies that how many times can you run an iteration? Can you take all this data, look for patterns in it, and spit something out that looks like a human could create it? And it's somewhat wild, but but at this point, NVIDIA handles about 80% of that.
Right, and so the stock is up dramatically, And we'll see. Here's the problem, though, with all of these technologies. Anytime you get a technological advance, the people who are most closely associated with it, the people who get very excited about a cutting edge breakthrough, they always believe that the technological revolution is going to happen far faster than it actually does.
Yes.
Now, having said that, technology, that's also true on the flip side. The naysayers, the skeptics, usually are wrong on the other end. They usually believe that it's not going to happen as fast as it does. The actual speed usually ends up being in the middle.
Well, this is a mania, right?
Yeah, absolutely. So this, to us, specifically NVIDIA, has all the earmarks of kind of a classic bubble, which could very well burst. And when we talk about bubbles, they're really driven by investor psychology. And the psychology, and we've used this chart for years, going back to 2012. A guy named Greg Davies presented this at the CFA Institute's Wealth Management Conference back in 2012. And he showed a chart about behavioral finance where the average investor starts with reluctance. And we see this all the time. People are reluctant to move. They are always afraid that now's not the good time. Is now the time for me to invest? That is the general default starting position of most investors.
Yes.
But eventually they follow something like AI, and they get very excited about it. They start seeing all this news. They start seeing companies like NVIDIA, their stock is going up
200% in half of a year, right?
Yeah, dramatically. Even before it was up that much,
sure.
They see it starting to go up. They start getting excited. And then at the very top, they're just downright exuberant.
Yeah.
And they kind of go over the moon. And that's really where it hits kind of 200% in a 6-month period of time. And then what almost always happens in the markets is, again, the technology adoption is not going to be as fast as people think it is. And when we start to get news about those kinds of things, the first reaction for most investors is they're going to be in denial because they see the future and they think, everyone's... we're all going to be unemployed next year because the computers are just going to run it. Computers are running everything. That's not going to happen.
Yeah.
And when it doesn't happen, they're going to be in denial about it because that's the natural thing. And then that NVIDIA stock will likely come back and turn over. Right? As we said, it was just down 70% last year. Mm-hmm. And so, and remember that going down 70% is a lot different than going up 200%.
Yeah.
You can only go down 100%.
Yep.
100% goes all the way to zero.
Yeah.
So, a 70% drop is a significant drop in a stock. And so when that starts to happen, they're going to get fearful, and eventually they're going to panic. And then finally they will capitulate. NVIDIA's stock will be down 70, 80%. And at that point, NVIDIA will probably be a good buy again. And but that is right where the mania investors are going to be getting out.
Yeah.
And at that, then you have the emotional feelings of now you've been burnt. And you're going to be a little depressed about it. And at some point, then you're going to be very reluctant again. You're all the way back to reluctance.
Yeah, it's just a cycle.
And it is just a cycle.
Plays out over again.
That plays out.
With individual stocks. With
over and over again.
The overall market and how people get in and out of the market to invest.
Right.
It's interesting, too. It's hard to know in sometimes where you are in that, right?
It's very difficult to know.
But there are moments that kind of have been telltale signs, and I always like to talk about it as oftentimes when you're in the exuberance phase is when, because we're professionals, right? We do this for a living, is when like people we know start calling us and talking about things like, hey, should I buy NVIDIA right now? Or just general people. Like my favorite story about this is, this was in I think 2020, when the meme stock craze was happening, and GameStop, had been up like 500% for no reason. It was not a good company, but its stock flew.
Right.
And our tech guy, our outsourced tech guy, like I was out getting lunch during a day, and he was looking at our network, and he called me and said, "Hey, is your network okay?" I'm like, "Yeah." I'm like, "You sound down. What's going on?" He goes, "Man, these GameStop calls are killing me." And I'm like, my tech guy is calling me, and that GameStop options are killing him. Like, this is a top, right? It's like when you start getting people to talk to you about these kind of things, tends to be a bad sign.
It does tend to be a bad sign.
And you're seeing that with NVIDIA a lot right now.
Right.
So we'll
you
see.
are seeing that with NVIDIA. And so I think that leads to the question of what are you supposed to do as an investor? If NVIDIA looks like it's crazy expensive and maybe setting up for a bubble, what can you do? Because first of all, we don't know when the bubble will burst. The bubble can get much bigger.
It could go for years.
It could go for years.
Or days.
And no one knows
You don't know.
that. If anyone claims that they do, they're just wrong. I mean, people were talking about a technology bubble. It's funny, in the aftermath of the dot-com bubble bursting, everyone says everyone missed it. That's not true. People had been talking about it since 1997.
Yeah.
It didn't burst until 2000.
Mm-hmm.
And so, it can go on for a long period of time, and who knows what NVIDIA will do. But here's a little trivia. One of us said, I'm not even sure who said it, that NVIDIA makes chips.
But that's not exactly true, right?
That's not exactly true.
Yeah.
NVIDIA doesn't really, they design chips. I mean, NVIDIA makes chips like most clothing manufacturers make clothes.
Yeah.
They have a label, and they put their label on a certain chip that is designed for them. It's their technology and all of that. But there's a company called Taiwan Semiconductor who actually makes NVIDIA's chips.
Yeah, like technically 10 or 15 years ago, the chip world changed, where it used to be that Intel and all these people made their own chips. They changed, and a few companies in the entire world make chips, and all these other companies design them. And Taiwan makes the vast majority of the chips in the world.
Right.
And all of NVIDIA's chips are almost all.
and they make all of NVIDIA's chips. And so so here's like a little compare and contrast. Now, Taiwan Semiconductor has benefited from this. They are up 40-some% year to date. That's not 192%, but that's
good.
Very good
return
over a 6-month period of time.
Mm-hmm.
And then, but NVIDIA is selling currently for 220 times earnings. So that means for every dollar that they earn, you're paying $220. Taiwan Semiconductor, who actually makes the chips, is selling at $16 for every dollar that they earn.
A price to earnings ratio of 16. Yeah.
Right. And so that is obviously a significant difference. Now, if this mania continues, Taiwan's probably going to continue to lag behind NVIDIA, but they're still going to get an incredible return. On the same time, it's also very important to understand that NVIDIA could go out of business and Taiwan would be still fine.
Making everyone else's chips in the world. Yeah.
They make chips for a lot of people other than just NVIDIA.
Yeah.
If Taiwan goes out of business,
NVIDIA's out of business.
NVIDIA's out of business.
That's right.
And so, so you also have, it's a larger, it's a more stable, it is a safer stock. Now, a lot of people are concerned about political risk with Taiwan Semiconductor because, as the name suggests, they are in Taiwan, and we have political tensions, obviously, between with China and whether China is going to do something about invading Taiwan. But it's interesting that people will talk about that with Taiwan Semiconductor, but they never seem to mention it when they're talking about AI and NVIDIA. So there is not a world where China invades Taiwan and puts Taiwan Semiconductor out of business.
And NVIDIA is okay.
And NVIDIA would be okay. So, that risk is really the same with both of those companies. It's just with one of the companies, people aren't even paying attention to it because the word Taiwan isn't actually in their name. So, so that is just an example. Another example, of course, is Microsoft. And you said it's so interesting. Microsoft is such an interesting story. As you know, we owned Microsoft years ago when most people didn't want to touch it because every quarter they were reporting earnings, and their total earnings were better than the market expected. But the earnings were coming from the gaming division. They weren't coming from, their bread and butter product, which was, the Office, the suite, the old school, buy the disk and upload it kind of program. And now, they are also one of the beneficiaries of this AI push. So much of that technology that they used to be a major player in the cloud and everything they're doing today came from gaming.
Yeah, the gaming played a big part of that.
And it's amazing how so many times when you allow for a free market, the most unexpected result comes from somewhere else in the business, and you don't necessarily see it coming. And it's also an example of where you get opportunities in the market because that was a great example. I mean, Microsoft stock was down to $20, and now it's what, 300?
Yeah, it's multi-hundred.
And so but back then, when no one wanted to touch Microsoft, it's because that all they cared about was that one business line, and they discounted the fact that the company was making money somewhere else. And there's a lot of opportunities that are created in the market because of things like that.
Yeah,
and that's really where you see, in my opinion, real opportunities. It's not from chasing things like NVIDIA, which who knows what will happen, but in all likelihood.
Yeah, well, the market is unbelievably narrow, right? With 7 stocks are almost all the return for the year to date. 24% of stocks are outperforming the S&P. If we were to stay that way for the year, this would be the most narrow outperformance in 50 years, right? This is a very rare occurrence when this few stocks outperform, and that's almost always a telltale sign that, again, what we already talked about, mean reversion will most likely occur. Now, whether it's today or whenever it's going to happen, but you see these times. There's a lot of historical times where these mean reversion themes happen over and over again, like it happened in '99. There's been a lot of them where these have happened. Technology tends to be a part of them lately.
Right. No, you're absolutely right. So a lot of the things, for example, dividend-paying stocks, which did extraordinarily well in 2022, have just been unduly punished in 2023. And so much of the story doesn't even really make sense. So people are excited about, AI. They're excited in general about technology, but we still have this backdrop in the market where pundits just don't want to admit that they're wrong about the economy as a whole. They keep insisting that there has to be a recession. It's almost like it's a religious fervor. They refuse to actually see the data, and they keep saying that we're going to go into a recession. And their argument is that technology stocks and a brand new technology or a breakthrough in AI will do well regardless of the fact that we may be in a recession. Well, okay, let's just say, for the sake of argument, let's say that they're right. We do go into recession. Okay, they may be right about those technology stocks. They may be able to continue to grow. But you know what else does really well in a recession? Dividend-paying stocks that don't go out of business do really well, in recessions. Just because technology has become kind of counterintuitively a defensive area doesn't mean that old school defensive stocks don't work when the economy slows down.
Yeah.
And so it's really absurd that you've seen this kind of situation where utilities have just been taken out to the woodshed.
Well, I mean, year to date, the highest paying stocks in the S&P 500 are down about 4%.
Right.
And the S&P is up over 10. Like, that's wild. That's an absolutely wild situation, especially in the context of a higher interest rate world,
right,
of a higher inflationary world, right?
Yeah.
Inflation is high. Historically, during periods of high inflation, so dividends, going back to 1930, have been about 40% of your total return in the stock market.
Right, absolutely.
Now, if you look at periods of high inflation, the 40s and the 70s,
right,
that got to 65 and 70% of total return. Now, if you look at 2010, that was about 17% of total return. When rates are very low
for the decade
for that decade of 2010s, yeah. When rates are very low, there's nowhere else to put your money. But in
right,
a world where you can get 4 and 5% out of cash, there is an alternative. Having something that pays you income while you're hoping to get some of that capital appreciation, that tends to be a very large portion of your total return. And it sure seems like that's where we're going to be going forward.
Yeah, absolutely. I think we are setting up for a situation where you're going to have the value stocks come back. So the setup we have right now, and you think about what those value areas are, and so many of the high dividend payers, where they are. You've got energy. Well, right now, oil is right before I came in here, it was at $72. This morning it was at close to 70. So it's up dramatically today, but it's at the bottom end of what's really been a very sticky range. And so, oil for the last year and a half, maybe 2 years even, has just kind of drifted between 70 and on the high side 85, 90,
Yep.
And it just keeps going back and forth. We are about to enter the summer travel schedule. There's going to be a higher demand for oil. The economy continues to be better than all these people are expecting. You're going to continue to see demand for oil.
And supply will, demand should stay high and supply should stay low, because there are political reasons and a lot of other reasons why you can't invest in production as much as we should have, historically and even currently.
Absolutely, and that's right. You've got a constrained supply, which is largely being constrained, as you said, because of political and policy reasons. So you're likely to see energy companies do well in the second half. You've got banks, and you've got the situation with the regional banks, which was deemed a crisis. The truth is there is no crisis. What we do have is a difficult environment, and you have banks coming out of a period of time that was extraordinarily easy for banks. You had interest rates all the way down to zero. And people have to think about what banks do in their core business. They borrow money on what we call the short end of the yield curve, where the Federal Reserve is literally just giving it to them at 0%. and then they loan it out to people in businesses and others at for a longer period of time at higher interest rates than what they typically get it for. As the Fed has raised rates, that makes that environment far more challenging for banks. And so we have been in a challenging environment for banks. A challenging environment is not the same thing as a crisis.
No, you have bad
Right.
actors.
Yeah.
You have people that haven't. You have your banker, but you have institutions that haven't done the things that they should have.
Right.
But that does not mean that the entire sector or industry is in a crisis.
Right.
Even though it's priced at crisis levels currently.
Exactly. We have valuations in banks that we have not seen since the actual financial crisis,
Yeah.
which was a crisis back in 08 and 09. And they should rebound.
All
and
they need to do
rebound
is survive
directly.
here.
Oh, absolutely. They don't have to do.
They don't have to do much.
They don't have to do much at all.
They have to survive, and we have to see normalization in the overall interest rate environment.
Right.
And
which we have.
Which we've already seen.
So you've got the Federal Reserve now. The market was shocked, last week when they were not shocked by what the Federal Reserve actually did, which they paused. I believe for the last time. I don't think they're going to do anything in the future. Except maybe talk tough. Mm-hmm. They suggested that they might come back and raise 2 more times. Everyone was expecting them to suggest that they might raise 1 more time. Mm-hmm. But we're talking about quarter of a basis point.
Quarter of a percent.
25
basis points, yeah.
25 basis points hikes. They've already gone up 5%.
Yeah.
Another quarter raise is not going to make a difference. No. And 1 more on top of that, it's silly.
If there is damage, it was done.
The damage has been done.
There may not be damage, but if there was damage, it was done.
Yeah, absolutely. So the idea that is going to be the straw that breaks a bunch of banks' backs just seems quite ridiculous to me. And then that's not to say that there won't be some poorly run institutions that go out of business, but that's the way that the market is supposed to work.
Yeah.
Poorly run businesses are supposed to go out of business. And that's what makes capitalism work in the long haul, is that you have to actually be a well-run business in order to survive and thrive. And we shouldn't be all bent out of shape over 1 or 2 bad actors, all of which had, very unique characteristics, really getting what they were, frankly, getting what they deserve.
Well, and from an investor standpoint, if we look at that investor behavior chart again, where do you want to invest in something? Do you want to invest in something during the exuberance phase when
Right.
you've already gotten a 200% return, or do you want to invest in a phase which one thinks is closer to either capitulation or despondency?
Yeah.
Right after you're depressed, that's actually when the time to buy. Walter Deemer's an old technolit. He's an investor, a Wall Street guy, and he had a comment I've always loved, which is, the time to invest is the time you don't want to. I'm
Right.
kind of, mutilating that a little bit, but the idea is that a great investment happens when
Right.
it's not easy
Yeah.
to want to do it, and so that's again that's how you actually make money in investing.
No, that is exactly right. You want to be greedy while everyone else is fearful, and you want to be fearful while everyone else is greedy. And so when you look at what's going on in the market today, people are being very greedy in a very small segment of the market. Primarily, we talked about 7 stocks because it's 7 stocks that drove it. It's really 1 stock. We're talking about NVIDIA.
Everyone else is riding
and everyone else is riding. Yeah, exactly. In the meantime, you got 493 stocks in the S&P 500 alone, let alone all the smaller companies and international opportunities and everything else, where investors are frankly being very reluctant, and that's where you're going to get the best returns.
Yeah, I think our view
over time.
Yeah, our view here. There's a lot of different ways this could go, but with the economic backdrop that we have and kind of what's happening in the markets and whatnot, it would seem that the the most likely path forward is that those large companies that have done so well flatten out, go up a little, go down a little, but whatever, they could stay relatively stable, and all the others catch back up. And that's the mean reversion that we're most likely going to see. Now, whether that's this week or toward the end of the year or when it happens, but one sure would expect that's the natural progression of how it should go.
Well, and as we have talked about for years, I mean, since the inception of our firm, it's far easier to know what is going to happen in the market than to know when. And you're right. This could continue to go on for some time where it's only 7 stocks. It doesn't feel like it to me, but that's just, my best guess based on experience. It feels like we're at an inflection point where you're starting to see the market broaden out. But eventually the market has to broaden out. It has to. So, and that's why being a prudent investor takes patience.
Yeah, patience is the key here.
Right.
Markets rotate and change, and it is unbelievably important to know when patience is kind of the most important factor, which truthfully in investing, a lot of times it is simply patience that pays off.
And what's funny is in hindsight, it doesn't even seem like it's all that much patience. We're talking, this entire talk has really been about what is not even quite a 6-month period yet. And in the grand scheme of life and in the grand scheme of investing, that's a very short period of time. But when you're living through it, every moment seems like it lasts so much longer.
And fear of missing out is an unbelievably powerful psychological force that investors and everyone in the world has to deal with.
Well, it is. And I think, maybe we wrap it up like that is because there are ways of getting, if you're afraid of missing out on the AI push, there are ways, as we have talked about, that you can get exposure to those types of companies without having to touch the hottest iron in the fire. Microsoft benefits from AI, but Microsoft has a much broader business than just that, and is basically a big blue chip company that's still going to hold on and do well even without AI. Taiwan Semiconductor, we just mentioned, they're the ones that actually make the chips. There's no universe where AI takes off that does not benefit Taiwan Semiconductor. But they're a much more stable business. They're selling at a much better price than say NVIDIA. And so there's different ways of doing that. And the other thing is to remind yourself, as a prudent investor, you always have to stay diversified. You can't have all your eggs in one basket. And in a moment like this, where diversification doesn't work, where we don't have equity in the equity markets, where all the returns are going to less than 1% of the stocks, then it is really hard to stay in, diversified, because you look at your portfolio and you're like, why are we not going up, even though everyone says the market is, or not going up as much? And the reason is it's completely skewed by 7 stocks.
Well, I think that's a good place to end it.
It is.
Thanks a lot. We this is a fun one. I enjoyed this one.
Yeah, absolutely.
We'll see y'all soon.
See you.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and wherever you listen to podcasts. Thanks for joining us. We'll be back with another episode